Hey guys, my name is Sukhman and welcome to my video about accounting essentials. Let's start off by learning about accounts receivable. Accounts receivable are funds that customers owe your company for products or services that have been invoiced. The total value of all accounts receivable is listed on the balance sheet as current assets. A notes receivable is a written promise to receive a specific amount of cash from another party on one or more future dates. This is treated as an asset by the holder of the note. When a note receivable is issued, the party making the promise is known as the maker, and the party whose funds are being promised to is the payee. The three major components of accounts receivable are as follows: recognizing accounts receivable, valuing accounts receivable, disposing accounts receivable. Start off by understanding recognizing accounts receivable. This section basically lets the reader know where the accounts receivable account is written on a journal, when a sale is made, returns and allowance and cash is received from goods that were previously sold on credit. Now let's talk about valuing accounts receivable. Valuing accounts receivable is a practice that accountants follow to ensure the accounts receivable account is not over or understated. To ensure this does not happen, accountants use the net realizable value as the amount of funds a company expects to get from a sale made on credit, as there are many cases where the full amount of the sale is not paid by the customer. To determine the account the accountants predict will be uncollectible, they use two methods, which are as follows. Allowance method. The allowance method involves setting aside a reserve for bad debts that are expected in the future. Think of this account as a rainy day fund. It is predetermined amount set aside in order to balance bad debt. Secondly is the direct write-off method. In this method, no entries are made to the bad debts account until the funds are determined to be uncollectible. When the amount is determined to be uncollectible, it is considered to be a loss and it is added to the bad debt expense account on the income statement. Now let's talk about the basis for allowance method. To determine the amount that will be uncollectible, accountants use one of the two methods listed below. The percentage of sales method estimates uncollectible accounts from the credit sales of a given period. In theory, the method is based on a percentage of prior year's credit sales. The second method of estimating the allowance for doubtful accounts is the aging method. All outstanding accounts receivable are grouped by age, and specific percentages are applied to each group. The average of all group results is the estimated uncollectible amount. Now let's talk about disposing accounts receivable. Factoring. Accounts receivable factoring is a financial transaction in which a company sells its accounts receivables to another company or the bank at a discounted price so that the company that is selling the accounts receivable does not have to chase down the customers from which it needs to collect its receivables from. Secondly, credit card sales. Credit card sales are another type of approach companies use if they do not want to deal with issuing credit and the paperwork that comes along with it. If sales are made via credit card, a company receives funds for the transaction more quickly from the credit card issuer than it would have if it made the sale on credit. Parties involved in credit card transactions. The credit card issuer issue cards to consumers. They process applications, check credit card reports, and approve or deny credit limits on cards. The retailer sells goods or services to cardholder and accepting payments from credit cards. The customer, who uses the card being used to make a purchase. Debit cards. Transactions made by a customer using a debit card are considered to be cash sales. Other non-bank cards. When the customer makes a purchase using a non-bank card such as American Express, the company that sold goods or service records this transaction as a credit sale rather than a cash sale. This is because American Express needs to pay the company that the customer bought the goods from after the sale was made. Therefore, it is written as a credit sale. Now let's talk about capital assets. A capital asset is an asset that will be used to your business over a long period of time, usually more than 2 years, and costs more than your usual day-to-day running costs. These types of assets are generally not intended for sale to customers. They're also called fixed assets because of the fact that these assets will not be used up or sold within the current accounting period. Capital assets can be either tangible or intangible depending on whether they have a physical substance or not. Tangible assets. A tangible asset is a physical property. It can be touched. This term is associated with fixed assets such as machinery, vehicles, and buildings. Natural resources such as mineral deposits, oil, and gas reserves are also considered tangible assets. Natural resources are considered to only be replaceable by an act of nature. Intangible assets. An intangible asset is an asset that lacks physical substance and has long-term value. Examples are patents, copyright, franchises, goodwill, trademarks, and trade names, as well as software. These assets can provide a business future benefits and privileges. Some intangible assets cannot be amortized, such as patents, copyrights, goodwill, etc. Therefore, they are considered to have indefinite useful life. Determining cost of capital assets. To determine the actual cost of capital assets, you need to take in consideration the following: cost to acquire the asset, purchase cost, freight expense, etc. Cost to make it ready for its intended use, installation cost, maintenance expense, etc. Cost of land/property. Cost of land is determined by the cost price plus renovations, upgrades to the property plus legal fees. Upgrades can consist of parking lots, fencing, landscaping, lighting, etc. Amortization. Amortization is the process of incrementally charging the cost of an asset to expense over its expected period of use. To calculate the amortization of an asset, you need to take in consideration the following: cost, initial cost of the asset, useful life, estimated service life of an asset in use, salvage value or residual value, how much an asset will be worth after its intended period of useful life. Amortization expense can be calculated in three different methods: straight line method, units of activity method, declining balance method. Straight line method. With the straight line depreciation method, the value of an asset is reduced uniformly over each period until it reaches its salvage value. Units of activity method. The units of activity is a depreciation method in which useful life is expressed in terms of total units of use expected from an asset rather than as a period of time. Declining balance method. Declining balance method of depreciation is an accelerated depreciation method in which the depreciation expense declines with age of the asset. Expenditures during useful life. The maintenance/repairs needed to increase the efficiency of an asset are called operating expenditures. When funds are spent to maintain physical assets such as property, plants, buildings, technology, etc., they are referred to as capital expenditures. Capital asset disposal. A company may dispose of its asset because the asset is fully depreciated and must be disposed of, or the asset is sold because it is no longer useful or needed. Capital assets may be disposed by retirement. An asset can simply be decommissioned when it fully fulfills its useful life. Sale. An asset can be sold before its initial retirement date. If an asset is sold more than the residual value, it is considered to be a gain. If the asset is sold less than their residual value, it is considered to be a loss. Exchange. Company can choose to exchange assets between each other. When an asset is disposed of, its net book value is eliminated. This is done by crediting the net book value on the journal. Thank you guys for watching my video.